All right, let's jump right in. We're going to tackle a term you've probably heard a million times in trading, but it's also one of the most misunderstood: overbought. So what is it? What does it actually mean? And more importantly, how can you use it to make smarter decisions instead of just panicking? Let's demystify this thing.
You know the feeling, right? A stock is just skyrocketing, going up and up. And that little alarm bell in the back of your head starts ringing. This can't last, you think. It's gotta crash. This is the exact fear that the word overbought preys on. But is it really that black and white? Is a stock that's on fire automatically destined to burn out?
So, first things first, we've got to bust a major myth. There's this huge misconception around what overbought really signals, and honestly, it's a trap that causes a lot of people to make the absolute wrong move at the worst possible time.
And here it is. This is the single most important thing to get. Let me be super clear. Just because a stock is technically overbought, that does not mean the company is bad or that the price is guaranteed to fall off a cliff. It is not a fire alarm telling you to sell everything and run for the hills. Thinking that way is a recipe for disaster.
Okay, so if it's not a doomsday signal, then what the heck is it? Let's get into the real definition, the way smart, strategic traders actually think about this.
The key words here are everything: quickly and unsustainable. See, it's not about how high the price is, it's about the speed of the climb. Think of it like a sprinter. It's a signal that buyers have been pushing so hard, so fast, that the momentum might just be running out of gas.
And this distinction is huge. An overbought signal suggests we could see a pullback, a little dip, or a correction. It is not screaming crash. It's more like a whisper that the market might need to just take a breather for a minute.
So you might be wondering, how do traders actually spot this stuff? Well, it's definitely not a gut feeling. It's not about vibes. They use specific tools, technical indicators designed to measure this momentum and see when things are getting a little overheated. And these are the big three, the usual suspects in a trader's toolkit. You've got the Relative Strength Index, or RSI, the Stochastic Oscillator, and Bollinger Bands. Now, they all work a little differently, but they're all trying to answer the exact same question: has the buying gotten too frantic, too fast?
And what's awesome about these is that they're based on data, not feelings. They give you concrete numbers to watch. For the RSI, the magic number is 70. If it goes above that, it's considered overbought. For the Stochastic Oscillator, that number is 80. And with Bollinger Bands, it's more visual. You literally see the price bumping its head on the upper band or even poking through it.
Look, if you remember just one number from this whole thing, make it 70. It's the most famous level for the RSI. When a stock's RSI crosses above 70, it's like a little flare goes up. And believe me, traders everywhere are paying attention.
But, and this is a really, really big but, you can't look at these signals in a vacuum. A super strong stock, one with incredible fundamental momentum, can stay in that overbought zone for weeks, sometimes even months, while it just keeps climbing. A strong trend is a powerful force, and it can just steamroll these signals for a while.
Okay, so let's play this out. You're watching your stock, and boom, the RSI ticks over 70. What now? This is the exact moment that separates the amateurs from the pros. It's all about making smart, calculated moves, not emotional ones.
You really have two different mindsets here. The panic seller sees that signal and just mashes the sell button, terrified of a crash. But the strategic trader, they see the exact same signal, and their first thought isn't sell, it's review. They think, okay, time to check my game plan and manage my risk.
So what does that strategic playbook actually look like? Well, for one, instead of selling everything, you could just tighten your stop loss, kind of like raising the safety net to lock in more of your gains. Or you could take some partial profits, sell a small piece of your position, and put some cash in your pocket. And hey, if you are thinking about buying the stock, this is a flashing sign to maybe pump the brakes and wait for a better entry point.
And here's a real pro tip. Never, ever rely on just one signal. An overbought RSI on its own is interesting, but an overbought RSI right as the stock is hitting a known price ceiling, a resistance level, whoa, now that is a much, much more powerful message. It's about putting all the puzzle pieces together to get the full picture. So after all that, let's just boil this all down to the single most important thing. What's the one core idea you absolutely have to understand about overbought stocks? Here's the bottom line. You have to reframe what overbought means in your head. It is not a sell signal. It is a risk management signal. Think of it less like a big red stop sign and more like a yellow caution light telling you to slow down and pay close attention.
And so I'll leave you with this final thought. The next time you see a stock chart that's going straight up, what are you going to do? Are you going to react to the fear, to the noise? Or are you going to use these tools to take a step back and actually read the momentum? Because trust me, the difference between those two approaches, well, that's the whole ballgame.